How to price your startup. I've had this question asked to me multiple times. And instead of repeating myself multiple times, I thought, okay, I'm going to record this video and help people figure out how to price the startup, right? So first is it depends. There's just no one pat answer on how you're going to price the startup. And let me just let you know, just like all things startup, it's going to be an iterative process. I don't think I know of one company that has ended up with the same pricing as what they started with. Either they discover that people pay more, or they hit resistance and people pay less, or a competitor comes and starts to eat your lunch. So you adjust your pricing, or you go through several rounds of price optimization and you end up figuring out, all right, this is the pricing. And if you're in a totally new category and no one's ever used your type of product before, or you're not sure, it's a little different from things that are out there, well, this is going to be a situation that for you begin to figure out, all right, how do we iterate to get to the final pricing? So take it like all things startup, build, measure, learn is the way that we do MVPs. Build something, measure it, and learn. I like to say try, measure, learn, right? Try, measure, learn, and then try again and go over and over again. So let me just start off with that type of principle. But let's get into some ways that you can approach pricing for your startup, which is extremely important. And again, moving targets. So don't get all twisted up. If you don't get this right out of the gate, it's going to be a moving target and iterative process. All right, so let's start off with the basics and how you're going to do it. And I'm going to draw sort of a way that you can go bottom up or top down when it comes to your pricing. And this is how I do it. And there are other models out there, but this just works for me and it's very helpful. So what you're going to do is start off. This is your bottom up approach. And so you're going like this, bottom up. And what you're trying to figure out is unit economics. All right. So your unit economics, you need to know your numbers. So what are the hard costs that go into it? So for example, COGS, cost of goods sold, and all the different types of overhead that are going to go into the unit economics. And you're also going to build in different things like, desired profitability and target, and do all these different models in there. So everything that goes in your business, you have to understand and figure out, all right, if I sell it for this amount of money, this is the target area. If I sell it for this amount of money, then do I end up with the profit? Do I cover my expenses, et cetera, right? And there's a lot of flexibility in the unit economics that you're going to see. If the market is not going to bear the pricing that you need, well, you can adjust your unit economics in terms of cost of goods sold. So just for example, rule of thumb, anything under $300 that you're going to pay, that you want, B2C market, you want it to be self-serve. So you can't add a whole bunch of customer service and your sales process if you're selling something under $300. Above $300, that's an area, generally speaking, where you can start to add some manual process, some labor and different things like that. And this includes your sales tactics and your marketing and all the go-to strategy, et cetera. You want to put all that in there. So knowing your customer acquisition costs are going to be very important for you economics. So if you're selling a product for $20 and it costs you $15 to get that customer, well, you're going to have to adjust your unit economics. And that's how you start to make those decisions. All right. So that's the bottom up approach. You got to know your numbers. Now let's pick a good color for the top down approach here. And all right, so I'm just going to pick this color here, and here we go. So now we want to go this way, and okay, excuse my messy diagram here. So we're trying to get into this target zone here, and then there's going to be like a little bit of overlap right in here, and this is where your pricing is going to end up. And then this up here is the market. So these are all the external conditions that you're going to be looking at, and you got a stack of decisions that you have to make up here. So for example, competitors, what is the competition doing? And by competitors, I don't mean just direct competitors. They're indirect competitors as well, alternatives. Or what is this? What do people normally do when there isn't this type of solution or something that you're providing? And for example, if let's say they normally could go to this type of store to buy it, and they don't realize that it's available online, well, maybe what they do is they keep buying at the store, and it's not direct competition because they're buying another type of product that could solve that problem or at least mitigate it or make it work better. I don't know what that looks like, but it all depends. So you got direct competition and indirect competition. It's very important to think through the psychology, the mindset of what people are paying. In general, what I like to say is you want them to see some type of 10x value if you want to disrupt the competition. So I could be paying $1,000 over here, but if I paid $100, well, then that's 10x value. And most likely, if you're going from $1,000 price point to $100 price point, you're going to have to work on your unit economics and maybe automate it. So you see how these two kind of come together, and there's a top-down approach and the bottom-up, and they both affect each other. So you got market, competitors, and you really want to ask the question, what are they willing to pay? Again, excuse my terrible penmanship there. And that's all about customer discovery, going and talking to people and understanding your personas and how much disposable income they have or what they normally spend on these alternative solutions and what are they willing to pay, and can you show them a better value proposition? So this overlap area, let me get another color here. This overlap area is your value proposition, and the next thing you got to do is communicate that value proposition. So again, let me just do this. Work from your unit economics, work up, understand, and then work from the market conditions and all the research and go top down. And eventually you're going to find that price point, that overlap between the two that makes sense for you, and then just project it out. What I recommend that founders do is just put a spreadsheet. Take a spreadsheet and say, okay, if I grew by X% per week in sales and what have you, and I look at this financial model with all the overhead that I got, am I going to get to profitability? It's another great way to analyze your cash flow and how much investment they have to come in. Let's start with your pricing. And I run this model all the time. So my spreadsheet, I don't have one to show you right now, but I'll just put one field as my price. And then what'll happen is I'll just play around with it and I'll say, okay, based on this, how much does the profitability change and when can I get profitable, et cetera. And so that's part of the game in startups, is to figure out, all right, not only do I need to figure out my pricing, but I need to know, does this pricing work for my pathway to profitability? Because guess what? Investors are going to be looking at that as well. So I hope this helps to help you decide how to do pricing, especially if you're doing something new and you're in a different market and you're just trying to find price discovery. And that's really what it is. Not only are you going to do customer discovery, but price discovery is a term that comes from trading in the financial markets. When a stock hits a new high, it goes into price discovery mode, and it's up to the market to decide how much they value and what they're going to look at it based upon the fundamental, the technical indicators, the fundamentals, and the market conditions, micro, macro. And so what you're looking at, let's say in this model, and here's something to really think about here, is this model right here. You may say, okay, this is the micro in terms of what you're doing, and then this is the macro environment. And that's how it works in stocks and how it works in all different industries. Price discovery, you just work bottom up in your micro unit economics and work a top down in the macroeconomics. The state of the economy is another really big thing. Inflation, that's another major issue today. And are people freezing and is customer sentiment low? Or businesses, are they tightening up and they're spending less in your industry? Those are the macro conditions. Look at those various factors and then go bottom up, top down, and get in a price discovery mode, continue to iterate, and eventually you're going to get there.